So today I come to you guys with, in my opinion, some bad news. I think that, obviously I try always put a positive spin on a lot of things when I talk about stocks on the YouTube channel. I'm normally a perma bull, so I'm always optimistic about the stock market going forward. But yesterday I saw some bad news and I looked at some of the stock market reactions and I was like, wow, I thought this would have been priced a lot more negatively into the market now, and it hasn't. So today I thought I'd point this bad news out for you guys and how I'm going to prepare for this situation. So I hope you enjoyed the video. Let's get started. So overall, again, yesterday it was a fantastic day in the market. Personally for me, my account once again hit an all-time high, which is absolutely amazing. You look at DraftKings, once again firing absolutely amazing, up 48% year to date. Hims and Hers up 161% in the last year as well. Alphabet, Google up 44% in the last year. Meta up 87% in the last year as well. Mercado Libre up 32%. So my 5 biggest positions in the stock market all absolutely firing. The only one that isn't at the moment is PayPal. Absolutely stagnant. Basically flat for the last year in the stock market, so someone needs to give PayPal a little bit of a kick. But obviously the stock market was doing really well yesterday, my account was doing really well, and you look at the indexes, I mean the S&P once again hitting that all-time high, and also for the year to date up 14% year to date. But I looked at the valuations of the S&P 500 now and I was like, wow, you know, when you actually start looking at the valuations, we're at 28 times earnings, which is a lot higher than the historic 19 times earnings. We are a lot higher than what we have historically traded at on an average, and obviously on a higher end range. There's only a couple of times that we've really been higher on a P ratio basis, and when we have been on those kind of highs as a P ratio basis, we've normally seen a bit of a pullback. So I would say we're definitely in extended valuations here from a historic point of view, and I don't know how sustainable 28 times earnings is on the S&P 500, but it's definitely a lot higher, which is definitely a little bit of a worry. Now, combined with yesterday when we had some bad news and the stock market kind of just brushed it off, I looked at the S&P yesterday was up 0.85%, and I was like, hold on, why are we getting so excited at the moment? And that's the big thing that is making me worried about, is that we're at a higher end of evaluation, and the news out there isn't optimistic in my opinion. It's definitely something to be cautious about. Now, the first thing that happened is obviously we had the inflation data yesterday. Now, the inflation data came in pretty good. The consensus was 3.4, we came at 3.3, and we do have this 0.1 downtrend since March carrying on. But if you look overall, we're still very much stuck in a bit of a situation where that inflation isn't coming down to the 2% target at the moment. So overall, it's still not looking great. I mean, the last 3 months has looked a bit better, but it's still not great. And I saw the market get really excited about a 0.1% lower than expected. Like, I always can't believe when the market gets so excited about a 0.1 beat or miss. Like, it's 0.1, guys. You know, zoom out and look at the big picture. You zoom out and look at the big picture. Inflation, by now, I thought personally it would be into the 2% range, and it's not. I'm sure the Fed themselves as well, they thought it was going to get into the 2% range, and it's not. And that's the big issue at the moment. We aren't seeing inflation come down how we expected. That's the same for the Fed. Most investors out there, I would say for most investors, are thinking the same. Even the UK, you know, I can't believe we're in a position where we say UK inflation is even more rapidly coming down than the US inflation, and that's not good. You know, we thought that obviously the Fed would cut when we get to a 2% range, and we still haven't got to the 2% range where the Fed can cut. And then we had the Fed come out and Jerome Powell talks, and also this month we actually got a summary of the economic projections. And now the big shock for me, and I can't believe, I did see a few headlines in it, but I thought this would send the market down massively, and it didn't. So if you have a look here, the inflation figures that the Fed put out for 2024 was that inflation is going to be a lot more sticky. They thought the inflation is now going to be at the end of the year 2.6 from 2.4. So even the Fed came out and said, look, we don't think it's going to drop as much as what we were hoping for, which isn't good. The other thing that was a little bit worrying as well is that they're expecting the unemployment to go up a little bit more. Although it's worth saying the GDP figures were expected not to change. But the big thing was the Fed funds rate. So previously, we were expecting the Fed funds rate at March time to go to 4.6. So we're expecting 3 cuts in the inflation or the interest rates. If you look at the updated figures, it's now 5.1. That's a major change. That's 2 cuts. So we have gone from this year expecting 3 cuts, and within this 1 month here, we've gone down to 1 cut. Now, we all were kind of thinking, are we going to get these 3 cuts? Maybe it's going to be 2 cuts. But the fact that we went from 3 cuts down to 1 cut was massive. So for me, I looked at all the data here and I thought, okay, inflation's a lot stickier than what we thought it was going to be, and the Fed think it's going to be, or thought it would be. And if you look at the Fed interest rates, they're now forecasting 2 less cuts, only 1 cut this year. And when you do look at when the Fed are going to meet, you've got the meeting in July, September, November, December. So we might not even get that 1 cut they're now pricing in, from 3 cuts down to 1 cut. We might not even get that until December the 17th, 18th, which basically is 6 months away. Now, I'm sorry, but I personally think a lot of this optimism around the S&P in the last year, a year to date, or in the last year as well, a lot of this has been excitement over that inflation is going to be beaten, the interest rate cuts are going to come in, or we're going to have 3 cuts this year, and then all of a sudden within a month, or maybe the last couple of months, we've kind of gone, actually that inflation isn't dropping, we have the cuts not coming in at what we thought they were going to come in, but yet we're still pushing up more and more to an extended valuation. And then I start looking around what's going on at the moment in the US, and I start looking at GDP growth. GDP growth is starting to slow down. We're down at 1.6 this quarter, which is a lot lower than what we have historically traded at from a GDP point of view. We're normally 2, 3, 4%. We haven't really seen that slower growth since 2018-ish, or during the CV situation, or 2022 when the whole Ukraine-Russia situation happened. So the growth is slowing down there. These higher interest rates are affecting the US economy. Now, surely if the US economy is getting affected, we're starting to see companies' earnings affected, which we have done. Look at the amount of Q1 earnings where we've looked at a few companies and gone, that's not good. When you looked at Nike earnings, you've gone, that's not good. You looked at the likes of Starbucks earnings, you got, that's not good. There's a slowdown there. There's so many slowdowns going on out there. And the growth is clearly slowing down because of these higher interest rates. The high interest rates are affecting the economy. They're the highest we've been for, 22 years in the US. And it's clear that things are struggling, but yet the thing that we were all getting excited on and the market was getting excited on isn't happening. But yet we're seeing none of that negativity now priced into the indexes. And I was like, surely that should have been priced in. This is bad news that's not being priced into the market. And then I was starting to look at something like, the big thing is that I always said is that we won't hit a recession in the US unless, unemployment goes up. Unemployment goes up, that's when you start hitting potential fears of recession, because people start spending less, worried about losing the job. People lose the job, and then that has that knock-on effect that they're not spending, so other people don't get their income. And what have we seen in the unemployment rate? We've seen the unemployment rate in the last kind of 6 months. We have started to see that unemployment rate start ticking up, and we have pushed into the 4% range now, which is a lot higher than what we've been for a long time. So that unemployment rate, once again, that's the thing that I've always pointed out, was that's when I get worried. And when I look at that employment rate, I'm not worried yet, but I'm looking at it, and I'm like, oh, I'm starting to, look at that and go, that's starting to get a little bit worrying, and it's definitely something to keep an eye on. So that's not good as well going on. That's going on in the background at the moment. And overall, I just looked at where we're at the valuations, the S&P 500, the data that's getting weaker, the cuts that aren't coming, the cuts that we thought were coming are not coming anymore. And I just thought, this is bad news, and I just can't believe that we are where we're at with all this kind of bad news that has come out in the last 2-3 months. I would not expect it. So from my point of view, I look at that and I go, I'm just a little bit cautious out here at the moment. I'm a little bit cautious looking at what's going on, and there's a bit of a disconnect for me. I'm a little bit worried about where we're at in the market. Now, I've always said this before. What's kind of my plan with the stock market? Will I sell stocks? I won't sell stocks. I'll never time the market. I thought the warning signs were starting to appear, 2 or 3 months ago, and since then the stock market is up another 5%, and I'd have missed out on loads of gains. So I don't try time the market. That's the worst thing to do. You saw in 2022 where so many people thought it was only going to get worse from here, and then we had the big rally. There was a time during the whole COVID situation where people tried to time the market, saying, oh, it's only going to get worse from here, and within 2 months of the COVID dip, we were rallying back up, and people missed out on many gains. And I'll never try time the market. I will never stop dollar cost averaging into the market. I will always carry on buying a couple of stocks now and then. But what I will do is I'll increase my cash position from when I think we start to get to a market that's a little bit more heavy on the top side than the bottom side, and I think that's where we're at the moment. I am not near the optimistic JKR investing where we were in 2022, you know, when I was here on this YouTube channel going, there's opportunities out there, guys, go buy those opportunities. You know, you had the DraftKings, you had the HIMS, you had the Google, you had the Meta, Mercado Libre, PayPal, so-and-so, Celsius. There was so many opportunities out there, guys, and I was like, you know, you look at these opportunities, guys, ignore the noise. This is a really good time to be buying. And now I look at this situation and I go, I'm just nowhere near as optimistic. I'm not bearish, but I'm not bullish. You know, I'm very neutral on this market at the moment. And for me, I'm at that time frame now where we're not in the market where we were 2 years ago or even a year ago. I'm definitely at the time frame now where it's time to accumulate the cash a little bit. And that's the thing for me, is that I need to have a cash pile. I've not had a cash pile for the last kind of 2 years because I've just been buying. But now I've started to get into that time frame. That's the wrong chart. I meant to go on the S&P 500. Yeah, the last 2 years is, you know, that was the time frame where I was just buying all the way up to, you know, basically end of 2024. As soon as we got into 2024 now, I'm a little bit more like, you know, I've sold a few stocks for a good amount of profit. There's not as many opportunities to buy as there were 2 years ago. I'm kind of at that point of view now where I'm like, I'm just going to hold off a little bit. I've not had a cash pile for 2 years. I want to have a cash pile again. I'm going to build up to a 10% cash pile, which I have actually got to a 10% cash pile now. But even more, you know, that potential to build up to a 15-20% cash pile is something that I potentially look at a little bit more. Because at the end of the day, if we keep going up from here, in my opinion, we just get to more extended evaluations where maybe we don't deserve it. So for me, it's one of those where I won't sell things just because I think we're a little bit heavy on the top side now. I won't stop buying because of that reason, but I will potentially slow down the buying slightly, and I will focus on that cash pile. Because could I realistically see a 10% drop here? I think so. I don't think a 10% drop would be ridiculous. You know, when you look at the valuations at the moment and the effects that we're having on unemployment going up, inflation being sticky, the interest rate cuts not coming to potentially December now. Could there be a correction in these valuations? 100%. So if there is that correction, you know, you imagine if the S&P was to drop 5%, 10%, imagine what some of these stocks would drop. You know, imagine what would happen to the DraftKings, you know, HIMS, Google. You saw it in 2022, guys. You know, the indexes started falling, you know, 15%, 20%. You know, what happened to HIMS during that time frame? When that time frame happened, you know, you saw the likes of HIMS, even if I went from the SPAC price, it was 66% down. So these individual stocks will absolutely tank in that sort of situation, and there'll be so many opportunities, and I wish I'll have cash. So yeah, overall, you know, I'm a bullish guy. I normally talk to you guys really bullish about things, and you know, there's still definitely some individual stocks out there that I really like, but there's definitely a different market from where we were 2 years ago, where I'm just a little bit more cautious, and I'm looking at the valuations, I'm looking at this bad news out here, and I'm thinking, I don't know if all of this is getting priced in at the moment. So my opinion right now is just be a little bit cautious. You know, I think that anyone that's got who has been buying in the last 2 years, you're getting the rewards, and anyone that's now chasing, I think you're chasing, and it could hurt if it goes wrong, is what I would say anyway. So just my opinion out there on what I'm seeing at the moment anyway. So hope you enjoyed the video, guys, and I'll see you in a bit.